Good morning, everybody. Welcome to the Flow Show. A quiet week awaits us this week. Nothing to talk about, nothing to trade on. So we would best just put our feet up on the desk and have a little snooze for the rest of the week because there's absolutely nothing going on. I kid, of course. Just me, myself, and I this week. As K-Man's off tending to do some personal bits and bobs. So we'll kick off this week as we always do, just looking at prior headlines and then going over what's to come this week. Before I start, for any of you viewers who are not members of our community, you can take advantage of our trial. Get yourself in the chat room on our platform. $1 for 10 days. Obviously covers this week, all the central bank meetings, the election, and all sorts. So a good chance to get yourself in a good community and help you get through this trading week, which is going to be a pretty funky one, I can tell you that. Right, let's get stuck into it, see what's going on around the grounds. We'll start, where shall we start? Let's start with a bit of data because we've had some PMI data, the final manufacturing PMIs and provisionals for some countries. Kicking off with Spain. They came in with a surprise beat, 54.5 for manufacturing, bigger than the 53.1 and 53 prior. So more good news for Spain. They seem to be exceeding expectations on pretty much all fronts at the moment, one of the growth countries in the Eurozone. Italy, on the other hand, they went backwards. They were supposed to post a 5-pip rise to 48.8, but it came in at 46.9. So not good reading from Italy. France confirmed the flash number 44.5, down from September's 44.6 by just a little pip. So a bit of stability at least there. Germany, they actually improved further on their flash number 43 versus 42.6 flash number and 40.6 in September. And as you can see there, the pan-Euro number improving a point over the flash 45.9 as well. So it looks like we've seen manufacturing maybe bottoming out in some countries, not according to Italy, but some countries might be seeing a bit of a bottoming out going into the latter part of the year. Still, though, pretty much for all of them, we're in contraction territory. So it's just things are less crappy than they were last month in some cases. Not a lot of headlines out from Europe, so we'll go over what happened in the US on Friday. Obviously, non-farm payrolls coming in, and I wasn't around for the non-farm payroll, so I was looking at it with sort of clean eyes afterwards. And overall, pretty much as expected. We said last week that the market was siding with a bad number, given all the strikes, weather, and all the related stuff there. So it wasn't a real shock to see the number coming out at 12K, though that still might have been a little bit lower than some had expected. But we've had previous Fed heads saying 100K potentially lost to the storms, another 30 to 40K or 30 to 50K lost through strikes and whatnot. So even if you add 130 onto that, 142 still would have been a solid number if it wasn't for that. So first thing I did, look at all the other details. Unemployment rate unchanged, 4.1%. Wages coming in 4%, going higher by a pip, although last month was revised down. So still solid numbers there. Participation rate dropping a little bit, 1 point. So that makes that unchanged unemployment rate all the better, if you like, because usually you get people coming out the market, the jobs market, you'll see the unemployment rate rising. So all the other metrics pointed to fairly as we were numbers. So the market obviously just looked at that shock number, but soon pretty much washed it out afterwards. Anyway, we did have the acting Labour Secretary in the US coming out saying many businesses were not hiring because of the hurricanes, but the overall labour market trend remains positive, and even with downward revisions, the 3-month average is up 148 100,000. Also mentioned how those labour strikes are impacting the jobs report. So this one pretty much flies by without too much fuss outside of that headline shock. Obviously, next month's number will be doubly important to see if there is a bounce back in those numbers. If there's not, and there's not further weather fallout, then that might be seen as a more negative number, but we shall see next month. We also got some PMI data from Canada and the States. Manufacturing in Canada improving 51.1. The US S&P Global PMI improving on the flash number and prior number to 48.5. Still in contraction, but as I said, an improvement there. But then the ISM missed expectations, but did go up over last month. So again, further improvements in these manufacturing numbers, albeit they're still in contraction. New orders doing a lot of the work there. It seems 47.1. Oh, sorry, what am I talking about? I was looking at that number there. Where am I? Here. Yes. No, it went backwards. I was looking at the wrong number. Excuse me. So the manufacturing PMI actually dropped 46.5 versus 47.6 expected. So down from the 47.2 prior. It was the employment number. Also, that was the one that improved over last month, although still deeply in contraction. Prices paid, probably the biggest number to take from that, a big jump there into expansion. So that gives further inflationary pressures for the Fed to deal with. Good luck with them this week. So overall, softer data in the manufacturing sector there, but it's been pretty crappy for a while. After that, it's pretty much it as far as the data goes. And from the news headlines, been a bit quiet on the news front on Friday. We did have further fallout from the UK budget, though with yields continuing to rise and pick up. And so that mess is still ongoing here in the UK. That's a big point to look at ahead of the BOE this week. So let's go over what's coming up this week. We'll start with some of the data points. The data is going to continue today. We get US factory orders, so keep an eye on those. Those will contain the durable goods revisions as well. Then we kick off the first of the central banks, the RBA, tonight. Now, they're expected to remain unchanged. What I'll be looking for from those guys is whether there's a further move away from their hiking stance. They're keeping the potential for hikes on the table. They had a subtle shift away from it last meeting. The inflation data since then has been weaker, so we might get yet another push away from the hawkish side. They maybe not by much, but it's a trend that might continue for the RBA. As I said, no expectations for any rate changes there, but I think the balance of risks is for a less hawkish slant from those guys. Then tomorrow we get a lot of the services PMIs and finals and whatnot, including from the UK too, and we get the ISM services number later on Tuesday in the US. Kiwi jobs data coming in that night as well. Further PMI finals and whatnots from the Eurozone and elsewhere on Wednesday. We'll see all those coming through. Keep an eye on this NBA. I saw the numbers last week weren't horrific, which again went against the weather-related stuff that's been going on, so they were pretty good. We do have Norges. This is on Thursday. Norges, Riksbank coming out as well on Thursday. The Fed is on Thursday. That's been kicked a day. Usually it's out on a Wednesday, but it's on a Thursday. I'm not sure if that's election related or not. BOE as well. We get some Eurozone retail sales. And then on Friday, not an awful lot out. Retail sales, bit of Italian data. the Michigan consumer sentiment, and Canadian jobs numbers. So overall, not a huge amount of data, but some bits and pieces to keep an eye on there. Right, just to go over the central banks. So the Riksbank, Norges, Fed and BOE are all on Thursday. The Riksbank is expected to go a 50 basis point cut down to 2.75%. Their Governor Janssen at the beginning of October said that 2.25s were the most likely outcome for the rest of the year, but a 50 basis point cut wouldn't be a big departure from normalisation or reduced restrictiveness. However, last week he did come out with a comment pretty much nailing a 50 hike, saying that they could move a bit more decisively on easing, which has cemented expectations. So 50 pips expected from the Riksbank, and then we need to see what forward guidance comes from that. Norges is expected to remain unchanged at 4.5%. They have been continuing to indicate that they will stay on hold for the rest of the year and look to start cutting in 2025. So that one should pass under the bridge without much fuss, unless, of course, they decide that things have changed enough that they want to slip in a little cut before the end of the year. The Fed, it's potentially going to be interesting because of the election coming tomorrow. The Fed are probably going to get a hell of a lot of questions, election-related questions, which they will obviously Powell will brush off because that's not something he will want to get stuck into, bar talking about the broad strokes of what policy may mean for future borrowing, finances, and the like. They are expected to cut 25 pips. Again, as Powell has indicated, he sees 2 cuts in the remaining 2 meetings of a total of 50 basis points, so likely 25 pips this meeting, 25 pips in December. Because they did the 50 in September, that, for me, it pretty much shot down any election shenanigans that could be levelled at the Fed. They've started their policy easing, so they can continue that irrespective of the election this week if the economy requires it. And I don't see much in the economy that says they shouldn't go at 25 at this one. Same for the Bank of England as well. Despite all the budget mess and the jump up in yields last week, they're still expected to cut 25. And this is something that's pretty important regarding central banks when you're talking or dealing with political situations like budgets and elections and whatnot. You always come back to what the economy is doing, what the central bank is doing. And unless there's been some real big shocks out of things like budgets, central banks are not going to change their plans. And I said, for the Fed, coming so soon after the election, we may not even know who the winner is come the Fed meeting. It may not be clear at all. So they will steer clear of that and they will just concentrate on the economy. And that's what you should do too. And obviously Tuesday is the US election, which is, I'm actually not looking forward to it because it has the potential to be really, really messy. And I don't like messy in my trading. So I'm probably going to be sitting on my hands a lot in terms of trading it. I'm not going to be staying awake for it. I'll give you a clue for that. I have enough to deal with my own lot over here in the UK without messing with you guys in the US. So I'm going to be more of a spectator over this than anything else, though I will be watching various assets, which I'll take a look at shortly. And speaking of the election, we've seen the Trump trade taking a bit of a bashing. There's quite a few gaps in various pairs and assets today, just as we've seen a bit of a reversal, as I say, in the Trump trade. Let's look quickly at yields as one example. So a bit of a gap down. This happened because there was a poll in Iowa, which Harris came out on top in that. And the reason why it's quite big news is that it's a very large Republican state in recent years. Trump won Iowa in his last two presidential campaigns, the term that he won and became president, and then obviously the rerun against Biden last time out. So he won Iowa quite strongly, and so that poll potentially switching to Harris and the Democrats was a bit of a shock for the Trump trade. What does it mean? Well, the same as everything. Polls are polls. Sometimes they matter, sometimes they don't. The market or the news headlines will always jump on the ones that were right and ignore the ones that were wrong. So, you know, it's a bit of a flaky analysis to take from, if you like, because if the Iowa poll was proved right, everyone will go, oh, that was such a great poll, and it will ignore all the polls that were wrong. So take these with a pinch of salt. Actual votes can be vastly different from what people say at the polls. They can say one thing, vote another way. But what it's told us, given the size of the gaps in some of these assets, is how much the market is or has been trading the US election, how much skin it's got in the game. So it's just going to give you an indication of what things are going to be like if we see a good outcome or a full outcome, a full result after Tuesday's election. If it's Trump, then we're probably going to see yields moving back higher. If it's Harris, we're probably going to see yields moving lower. So you know what to look for now. And I think you need to be watching yields. We always say keep an eye on yields, particularly if you're trading the dollar. But for this election, you need to have yields open on your screen throughout this. If you're going to be watch yields first, watch bonds first, and use those as your key to everything else. But make sure you look at the broad range. I like to look at the 2s and look at the 10s. 2 years because it's more reflective, obviously, of the shorter term. Whatever happens in the election, whatever policies come out from Harris or Trump or whatever, we're not really going to start seeing the effects of those for quite some time. The economy is still moving. We're still going to have data coming out. We're still going to have the Fed doing what the Fed wants to do. That's continued cutting. So you've got 2 different time frames to look at. Something like 2 years, which, as I say, more indicates the short term. And then you've got looking at something like 10 years, which is going to be more pricing what those policies might mean further down the line. So keep an eye on both of those and use those as your guide for the dollar. That's all from the headline front, at least. So let's get stuck into what's been going on. So as I said, quite a few gaps showing up. I'm not one for gap trading, first and foremost, but as I said, it has given us an indication of how the market is trading this election. So it's all going to be about the election. Things like data points are going to be playing second fiddle this week. So your ISMs, your factory orders, all that sort of thing is probably just going to be small beans this week. Okay, so once we get over the election, we know what mess that's going to be. We can only then start moving forward. But it depends, as I say. If we get a clear result, sort of Wednesday, then we can move forward and we know how to react to that. If it's a mess, the market's going to be a mess. And as I say, I'm probably just going to remain sitting on my hands until the picture becomes clearer. But market's going to move. And very interesting what I saw in euro dollar today. And this is why I've got this zone 108.30, 108.70, been on my chart for years and years and years, because it's pretty amazing tech area, if you like. We opened or we closed Friday bang on the bottom. We opened Sunday bang on the top, and now we've been pushing higher. So I don't know why it likes to move around these numbers. It is what it is. It does what it does. But these are the sort of areas you should have marked on your chart. At the very least, if you're not going to be trading off each individual level, which you can do if you're more short-term player, use it as a pivot point. Use it for when you're holding below. Use it for when we're holding above. And then you can assign your direction to it. Gives you something to lean on. If we get another test of 108.70 and it holds, then that increases the chances that we're going to be pushing higher. But it's playing really nicely with the tech at the moment, because where was the resistance? The resistance was coming in at this break point. We had a little mooch, this 109 and 109.10 area. You know, this was support on the way down. We mooched around it. We had a break under. Straight after the proper break, we had confirmation of that break. And here we have been holding it once, twice, and maybe thrice. So you know what's going to happen. If we break above here, then we're going to be heading up to the next level. 109s, 30s, 40s. Small steps for the euro at the moment. All bets will be off tomorrow, obviously. What I think this move does do is solidify this zone. This was the place where we stopped falling, and you know, we started picking up. We started seeing some higher lows. Then we got a little knock under, but we couldn't get back to that low. So you know, it's doing here, as I said at the time, what it hasn't been doing all since the move from 112. So if you want to be picking up the euro, this is the area you wanted to be doing it. Now, if you're looking on the other side, if you're looking for shorts, then you want this area to hold. But otherwise, and I'll probably need to chuck a fib in now, just from that high to low. So that fib, I think, comes in around, and let's just chuck one in. Stop being lazy, Ryan. I can do it without messing around too much. Boom, boom, boom. Oh. Get in there. Let's just change the color. Let's make it green, something different. So the 38.2 comes right in amongst that clutch of old fibs from all these moves. Okay, well, I should really take that yellow one out because we busted it all over the place, but it's been a bit of a level all on its own. So the fib, this move back up, comes in right around that zone. So that's going to make it another batch of tech confluence, as we've already had in there. Again, let me not be lazy. Let's take that one out. Oh, no. Lock that up. Let's take that one out. There we go. Just makes it a bit cleaner to look at. So that's the big level, 109.40s, then up in towards the high 109s, 109.80s. So keep an eye on that. All these fibs line up pretty nicely when looking at them. Dollar yen, that's been all over the place this morning. Still high volatility in there. That's not going to change anytime soon, I can tell you that. So a little bit of a gap there overnight. Not a big one, nothing to write home about, but a gap nonetheless. Again, this one is probably looking a bit anti or washing out a bit of the Trump trade as well, because as those yields are coming off, we're seeing dollar yen coming off, because it obviously this one likes to follow yields as well. We're under 152. We've been under 152 before, so this level really is just becoming a bit wishy-washy at the moment, but you can again probably use it as a bit of a pivot now if you start to see a solid hold below. Okay, we've been up and down all around it, not looking very clean at all. But if you get a solid hold more than once against that level, so it's becoming resistance, then we're probably going to be heading lower. And then you can use that as your trade line to trade. Main King, you want to look at Kiwi dollar? Certainly. Let's have a look at the Kiwi dollar. Not doing an awful lot, but a bit like the euro, it's stopped falling for now. Okay, so it's had a couple of attempts. We got a bit sticky around here before we got another breakdown. It's being a bit sticky again, but this one looks a bit more weaker on the bounces. I'd want to move back above, properly back above the 60 figure and holding above the 60 figure for now. So this one again, I don't think it's out the woods, but if you get another hold around this 59, 50, 60 area, then that will again confirm the support down here. Maybe it's just building a bit more of a solid base to have a push back higher. But yeah, that jobs report from tonight from New Zealand might be a bit of a factor in that. So if it's a bit of a weak one and we're down here and it holds, then if you're looking to get long, then that might be the area to do so. But if we're breaking back below 59.40s, even by a few pips, it's going to keep this downtrend going. And then you've got to be very, very careful. Let me know what you're doing as well, Main King. You're long, you're short. What's going on? What are you playing at? You're long. Okay, good stuff. I hope you're long further down, my friend. Yeah, you know your risks. Okay, this has been a prior area, prior low. Know your risks here. If we can't get up and hold above that 60 level, you might want to think about taking a bit more profit as well. Just protecting what gains you've got, and just thinking about what happens if we don't go higher. What are you going to do from that point? Brand cable, not an awful lot to say about this one. Bit of a wild horse still can't get above the 130 and hold above the 130 for any significant amount of time. So last week we did carry on making another low, although there's plenty of volatility in this one, but I don't think we've potentially stopped falling yet, or there's nothing here that tells me we've stopped falling just yet. We did have a tentative move back down to the 129, which held. So that might be a bit significant, stepping up off this low. But I'd want another confirmation down to 129, 129.90s. If we get a move down there and hold that, then that will set up a decent pattern where we've had a low, broken it, and then we've held the prior low. So down into 129, 129.90, 128.90s. If we hold another test there, again, that might then indicate we're getting a move back higher. There's still a lot of mess and fallout going on from the UK budget stuff last week. As I said, yields are still pretty elevated as the market's still deciding. People in the UK are deciding whether they're going to be packing up businesses, getting out of assets, so on and so forth. So the fallout from that is continuing. But, the levels, you've got to be getting back above 130 if you want to see further upside, and we can't do that at all at the moment. Ali, I said I don't trade US elections and finding it very hard not to trade. You're feeling like trading is an addiction, and if you don't trade, and there was something very bad happening in your body. You don't want trading to become an addiction. If it's becoming an addiction, then you need to do something about it, Ali. Trading is not an addiction. It's a profession. It's a job. So if you're feeling like you need to be trading all the time, then you're sliding into gambling mode, where you've got to do something. You've got to do something. That's not the way to trade. You trade when you have a trade, not when you don't have a trade and you want to force a trade. You can trade away through this election. There's nothing to stop you, but you will get the same warning from me. This is a high risk event. I'll use my old analogy of jumping into the ocean. Do you jump in when there's calm seas, or do you like jumping in when there's choppy seas with no protection? Depends on your outset. But for me, volatility is good, unless it's this type of potential volatility, which is unknown volatility. We don't know what's happening with this election. You can guess it. You can pick a side. You can trade a side, but then be prepared for that volatility. I don't know whether it's going to be Trump. I don't know whether it's going to be Harris. I know pretty much what the reaction's likely to be if it's one or the other. So I can formulate plans for whatever result. But over the event itself, when the results start dropping and whatnot, you could get some wild swings. And if you want to trade that, be my guest, not for me. Okay, I don't need to be risking on things like that. That's why I've stayed in the game as long as I have, because I don't need to go for big home run trades over things like elections and big risk events. I'd rather take lots of little runs than hit every trade for a 6. So if you are feeling the inclination to trade because you feel like you might be missing out on something big, just remember, you could make big money over this election, but equally you could lose big money over this election. The risks, both sides, to winning and losing in high volatility are the same. High high reward, high risk. It's not just favoured to the high reward side of things. So if in doubt, stay out. If you don't know what's going on in this election, if you're finding choppy moves, then, you know, sit it out, let the dust settle, have your plan moving forward. As I said, one of the things I will be doing when looking at price moves over this election is judging them against what the underlying fundamentals are, what the central banks are doing, so on and so forth. You know, what happens in the dollar is going to move a lot of other currencies. And if it moves those currencies to levels that are against what's happening in those countries, then that's the sort of opportunities I'll be looking for. You know, the UK still looking to cut rates, still got rates fairly high, still got all this budget stuff going on. If I see a big rally in the quid, that will go against the fundamentals and against what the Bank of England were doing. So that would be a potential opportunity I'm going to be looking at. Right, let's have a look at what's going on elsewhere. Dollar CAD still heading up towards that 140 level. It's creeping up. This one's been a bit more solid versus some of the other pairs, dollar pairs in particular. It's maintaining the trend, but it's not going any great guns. I did have my little long last week, which I managed to take some pips off of, but then got hit on my trailer, a pip above my entry point. So I'm flat here now, but still looking like it wants to go and have a look at 140. This might be the week it does that. I said I might like to trade 140 on a first test, but I'm not going to do that if it comes over some election news and whatnot, because if it's big news, then we could be off to a flyer in the dollar. So again, my trade ideas, might have been happy to do them last week. I'm not so keen on this week because of that volatility. Euro sterling is looking interesting as well. This one is more reflective of what's happening with the UK stuff. Pretty strong move, and we had another poke above this 84-84-20 area last week, but it didn't last, as you can see, and we had a pretty steep pullback. It's having another go this morning. So we've got a bit of continuation going on in this negative pound sentiment at the moment to do with UK politics. If we get above this 84.20, this will be the third time of asking since the breakdown below. That might be the move that has some legs. If you start to see it building, support 84.20s, if we get a move there, then we've got every chance we might be heading higher, maybe to go and test 84.60s, maybe even the 84.80, 85 zone. I know a few people jumped in longs in our chat room last week, and I was half tempted to do so. I didn't. So I'm sitting watching, but I think being long at the moment is probably the better side of the trade down here. Now, this is a pair you can trade if you want to take yourself out of the election noise. There's plenty of assets and pairs that won't be affected by the election. However, remember that even though it's not a direct election trade, it can be affected by the election because we have differing speeds between cable and euro dollar. Cable mostly moves further and faster than euro dollar does. So if there's a big dollar move, this could move as well, depending on which way it goes. If it's dollar strength, so we're seeing cable and euro falling, then this will be going up because cable, as I said, will likely be falling faster and further than euro dollar until it starts hitting some of its own strong levels. And then that might put the brakes on what happens in its dollar cousins. So for this one, I think it's a dip by euro sterling, mainly on pound weakness. So if you get a move that's showing in the dollar, that's showing this one coming back down to support 83s, I will be tempted to pick that up if that's happening on a dollar move rather than anything else going on in the Eurozone and US. So these, as I say, these are the type of opportunities I can look at trading over the election. Because if we're back down at 83 purely on a dollar move, that's going against the fundamentals of what's going on in the UK. So that would be a move I'd look to counter. So those are the sort of opportunities you can look for, as I said, when other currencies move out of kilter with what's going on with their direct fundamentals. What else shall we look at? Let's have a quick look at gold. I managed to do all right on this one last week before my days off. I managed to nip some out up near the top here at 86s, 87s Wednesday night. That proved to be a good move because obviously the data and everything else saw it collapse back down again. So it's got to do all the hard work again. Since it's moved back down, we've got to try and get back above this 27.58, 60, whatever you want to call it. We're holding back below it at the moment. So that's your level that we need to break back above again. Got a little bit of, let's chuck a line in there because 27.30s is obviously showing up as a little bit of a level. Now we've come down. This 27.40s, we're mooching around again. So again, it's just, again, becoming a bit of a wishy-washy level. I nearly pulled it last time. I might pull it again. We had this other level, 27.48, 49, which, as you can see, we came back down below it. We held as resistance. Then we found a bit of support, and now we're back below. So, again, I'm going to keep this line in there as a bit of, again, pivot line. If we're holding below it, then there's every chance we're going to be looking down a bit further. So we know where the close support is, 27.30s for now. Under there, we're looking at 27.13 down to the 27 area. The bigger number below is still 26.85. Okay, so that's the big key number there. Maybe you can stretch it down to that prior, all these prior levels down here, 26.70. So that's a bit of a zone down there. But if gold is going to continue high, and I'm not looking to add to back to my longs at the moment, again, this close to the election. But at least you know your levels now. Needs to get it back above 27.58, 60 before we even think about going back towards these highs. So if you're in gold at the moment, then we're in a little bit of a neutral zone for this one. I spoke about yields as well. Metals, yet Derez got into that. Again, Ellie, I don't know where I see gold into the elections. I think it's obviously going to move around, but again, come back to the fundamentals. What has been the reason why gold's been going up? It's not been the elections. Might have been the elections in this phase, but it's not been the elections for the last few months. So it's what's behind this move that is more important than the elections. Yeah, we get some volatility. But we know central banks have been buying, and if they're buying, they've got a big bit of support for gold. So after the election, what are going to be the fundamental reasons for gold continuing to go up? It's going to be those central banks continuing to buy. So pick your levels for this one. I'm more inclined to buy a dip if there's an election dip on this one, particularly if we get one down to these levels to add back to my longs. After the elections, I don't see any reason why the trend should break just yet, unless we get another move up to this high and it holds, and then we see a further pushback. So as far as the election goes, I'm inclined to be a dip buyer on this one. Yeah, Brad, there's lots going on in China. I'm keeping on dollar China as well. Again, this one looks very much, Trump trade related. We've had a big spillover down here, coming right back down towards, under 710, 711s, this area that we had been holding previously. So again, there's a lot of Trump in here, another little gap in that one. Obviously, you've got to, if you're trading FX, then you've got to keep things like the MEX, the CAD, CNH on your watch list as well, because again, if it's a Trump win, then these currencies are going to be impacted more than others, I should think, because it means renegotiation of the USMCA, tariffs on China, bum fights with other countries, etc. So there are, you know, 4, 5, 6 assets that will be key election traded assets. So if you want to gauge direction, you can look at those, and China's going to be one of them. Now, conversely, as I've said, if it's a Harris win, I think we pretty much quickly go back to trading the US fundamentals, because it will be a continuation of the status quo, which means not too much upset in terms of policy and the like. The only thing is how much more spending and borrowing she's going to get up to. That's something that you'll need to watch in bonds again. But I think the least volatile trade is a Harris win. The more volatile trade is a Trump win, and that's what I'll be looking at it from that perspective. And just in case you haven't seen it, I will put it in the Zoom chat here. Oh, if I can get the right link, give me 1 second. Oh, I'll tell you what, I'll get it from here. There we go. So the team have put together a blog post for the US elections. If you haven't seen it, it's in our chat room. But as I said, I'll put it here in the chat box in Zoom. So you've got that link there. Have a look. It's got the whole team, pretty much the whole team, talking about it. Blake, Stell, K-Man, Grasshopper, and me. So there's all several thoughts in there. A lot of them along the same lines. There are some differences, a few trade ideas in there, assets to look at, reactions to look at. So if you want to have a read of that, get yourself up to speed, then do so. That's in the chat room and in the Zoom chat there. Right. It's a Monday. I don't like talking too much on a Monday, so we'll call that a day. Obviously, we'll have the flow show tomorrow before the elections kick off in earnest, so we can talk about that in more detail. If you have any questions, final questions, or assets you want us to look at tomorrow, then get them together, note them down on a bit of paper, have them lined up ready for me, and I'll answer them as best as I can, and maybe I'll even bring in a guest or two tomorrow or for the rest of the week. Anyway, on that note, we shall call it a day. Thank you very much for coming to the Flow Show. Do have a safe week's trading. I don't want to hear of any horror stories this week. Account protection is your #1 priority this week amid the volatility. Have a good one, everybody. Speak to you tomorrow.